to know what it is that you want to accomplish in real estate. And if it's just continually building and, trying to make more and more and more, Triple Net probably isn't for you.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, it's Agostino. Imagine if you can get into commercial real estate without dealing with all the landlord responsibilities or management like you would in a typical deal, all while avoiding the economic uncertainty and all the fluctuations that come along with it. Well, there is such an asset, and it's called Triple Net Lease. Today's guest understands all about this asset class. He has been a real estate broker for the past 25 years, and he and his team have transacted over $1 billion worth of commercial real estate. He made his first million in self-storage before moving to Triple Net in 2015. Shortly thereafter, he founded Triple Net Companies, a group that helps investors buy and build steady cash flow with Triple Net space. With all that, I'd like to welcome Ken Brown to the show. Hey, Ken, thanks for coming on, man.
Well, thanks for having me. It's good to be here.
Yeah, it's going to be awesome. Now, if you like what Ken has to say, you can reach him via the contact page at their website, triplenetcompanies.com. And if you like our content, please don't forget to leave a comment and rate the show. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Ken, give the listeners a little bit more information about your start in the commercial real estate space.
So I started in the commercial space much like I think everybody starts in the commercial space, which is I started as a residential investor. And, I would buy and flip properties. And it was a lot of work to make a little bit of money, and it was a lot of risk. I'm a risk adverse person. So I got into the triple net space. The first thing I did is I was able to flip a single property in escrow and make a $250,000 profit. And with that, I got into self-storage where I made my first $1 million. And I was always looking for a better way. And in looking at the different types of commercial real estate, what attracted me to triple nets is that if you find a good tenant, then you don't have to worry about managing it. You don't ever have to worry about talking to the tenant. They pay all of the expenses, and they give you a 10 to 15-year lease. And it's not just any tenant. A well-chosen triple net property is a property that is tenanted by a multi-billion-dollar tenant that has an investment-grade credit rating that will give you a corporate guarantee, regardless of what happens to that store, regardless of what happens to real estate, regardless of what happens to the economy, regardless of what happens to the stock market. You are getting paid the exact same amount for the term of the lease. Now, if the store burns down and gets carried away by a tornado, or they don't meet their numbers, it's just not your problem. That is the tenant's problem. So if you have a store that burns down, to give you a wild example, worst possible case, you probably wouldn't be told about it because they handle the insurance, they handle everything. So I found that to be very appealing at a certain stage in real estate investing. And that stage is when you have enough and you just want to make sure that your cash flow is consistent and you sleep well at night. And that's why I got into triple net properties.
Nice. And the thing is, though, and just to delineate here, we're not talking about your typical, upper lower type scenario where there's a small retail space and 3 units up top or anything else like that. We're not talking about that here, guys. We're talking about investment grade, single tenant, for instance, more than likely, like say a Starbucks or an Advanced Auto Parts or one of those types of scenarios where it's a quality asset sitting off by itself, managed and run, or rather occupied by a very large tenant with investment grade money behind it. So a very different scenario, right? And those types of assets, Ken, those are the ones you're talking about, is that you're not worried about what happens. Like Starbucks is not going to go out of business tomorrow, right? That's the thing, so these are very different types of assets.
Yeah, you're looking at Starbucks, you're looking at CVS, Walgreens, the dollar stores, 7-Eleven, AutoZones, uh, auto stores, but some tenants are better than others. And that's where you start getting into the weeds. Starbucks is an excellent example because Starbucks will give you a 10-year lease, but they have got what we lovingly refer to in the business as a weasel clause, which is if they don't hit their numbers, they can get out of their lease. Perhaps my favorite weasel clause is Walgreens, where they give you an 80-year lease that's renewed every 5 years. That's a 5-year lease. So the devil is in the details. You have to not only have a tenant that is an investment grade, multi-billion dollar tenant that will guarantee your lease payments, but you need to make sure that the lease doesn't have a clause in it that allows them to get out. And there are leases where they can't get out, and there are leases where they can get out. And you have to read, or have your attorney, or have an attorney, or we read the lease to make sure that it is exactly what you think it is. Because in our industry, we use the word triple net, much like you, Agostino, use the word multifamily. So when you're talking about a multifamily, I might be talking about a 5-plex. You are talking about a 200-plex. So with a triple net, the definition of a triple net is it's actually a triple net lease in which the tenant pays the taxes, the insurance, and the maintenance, and then also manages the property. That is the definition. Now, there are some triple nets where the owner is responsible for maybe the building and the roof, and that is technically called a double net, even though for some reason brokers call it a triple net. That word has gotten sloppy, much like multifamily doesn't have a concise definition anymore. So the devil's in the details.
Right. And the thing is, though, with triple net, just so you pointed out too, those details could vary, right? It could be that even though they call it a triple net, you as the owner could be still responsible for the parking lot, or responsible for the roof, or responsible for the walls, or whatever it might be, right? So getting an understanding as to what the tenant's going to be responsible for, and what you as the owner is going to be responsible for, where that line, where it begins, is going to be is one of the things you're watching out for. Just one of the many things you're watching out for when you're getting into that business. But something that you pointed out, Ken, is that it sounds to me like you're getting into triple net after you've amassed some sort of I'm not going to call it a fortune, but you have some money. You built a portfolio of fix and flips, or single family homes, or a bunch of multifamily, and sometimes that cash flow is not always steady every single month, right? But with triple net, that's where the difference comes in, is that cash flow is very, very predictable. And by building a portfolio of triple net, you're able to get that predictable income for you and for your investors, right?
Yes, absolutely. So on my self-storage facility, that was 646 units. That's a given day 600 tenants. I can't imagine anybody who would want that.
Right.
Uh, it's so there's got to be a better way. Uh, One of the most important things that I could tell you is that you have to know what's important to you. My next door neighbor is a billionaire, and we go out to lunch occasionally, and all we talk about are the lawsuits he's in. When you have that many assets and that much money, it kind of comes with the territory. That's not the lifestyle I wanted. Uh, you in this business and in any business, you have to know what your goal is. You have to know what you want, and when you get there, you're done. and you go off and do something else. And in our case, we have enough money to do everything that we want to do. There are certainly a lot of people who are richer than we are, but I have, I have never spent since the night I proposed to my wife. We haven't spent a night apart. We travel around the world. Uh, that's what's important to us, and triple net properties allows you to do that because that each and every month that what will be in your bank account, and that gives you a tremendous amount of freedom.
Yeah, that's right. It's very, very, very predictable, right? And I think on the other side of the coin of predictability, however, comes the fact that it's not like a case where you're going to make these massive rent bumps and these huge value add type scenarios like you would in a multifamily deal. Like there's a deal that we bought. It's a tower in Cleveland. We bought it 18 months later. We're able to do a refi for almost $2 million more than what we paid for it. It's a good day when that kind of happens. You send out your investor checks, everybody's happy. So, everybody pops corks of champagne. Yay. That's it. Right. Until the next time you refi or the next time you push up rents or whatever. So that's where those types of crazy shifts occur. But in the case of triple nets, the cap rates are lower, right? And it's based on cap rate, unlike with multifamily. There's many moving parts, but it's very, very, very predictable. Like you're able to do monthly disbursements if you want to, right? Unless there's a major, major issue that the landlord has to cover that's maybe in the agreement. But for the most part, because of its predictability, you're able to entice your investors that might be interested in just getting a coupon. That's it, right?
Yes. Yeah. And I'm not saying that if you do triple nets, you don't only have to do triple nets. I'm involved in other ventures now because they're entertaining, but I can deal with those much more comfortably because I know that my mortgage payment isn't riding on the success of that new venture.
Right.
So that's another important element of triple nets. It gives you a solid foundation from which to build whatever you want to build. It doesn't mean that you have to retire. It just gives you lets you sleep better at night.
That's right. That's right. Like any business, even your own personal household, if you're treated as a business, there's a kind of, I guess you want to call it a level of which you have to have a certain amount of money coming in the door to satisfy everything you need for the household, right? And if you're able to build a portfolio of triple nets that could provide you with that level of income, still make investors money, you get to make money, everybody's happy. Why not do that, right? And that's a great thing that it does. It's very, very predictable, and you can still do those big deals. I mean, just like you pointed out before, many people they'll add triple net as like a next step to grow in their multifamily business, for instance, right? Or either that or self-storage is also another one as well. But I think I'm finding that triple net's become a more viable solution for many folks just because of the management involved or lack thereof. There's no management basically, right? It's very easy to manage.
There is no management, and especially today. So we're very busy. And the reason we're busy is number one, the stores that we recommend, the tenants that we recommend don't compete with Amazon. But they do well during a pandemic and they do well during a recession. And I suspect that's where we will be for a while. So when so much of the country is having difficulties and returns are all over the place, and uh, you know renters in multifamily, at least in California, don't have to pay. They've got a moratorium on evictions for some time. uh, Triple nets, the right triple net, will continue to pay through all of that and not miss a payment. And even though it's fun to think about making big returns, there are times when it's equally exciting to know where your income is coming from, where that's secure.
That's right. That's right. That's right. Now, when it comes to identifying a good triple net asset, like what are some of the things that you're looking out for? And you touched on, so, I don't want to call it Amazon proof. I think the more the more we go on, the more we're discovering that things are not all things are Amazon proof, right? But there are some things that are Amazon resistant, so to speak. And maybe we can explain that a little bit more around what makes a business Amazon resistant. But what are some of the other key elements that one should look for when they're considering doing a triple net type scenario?
So I have a list that a list of criteria that I require of each of my tenants. And that is number one, it has to be Amazon proof. And I'll touch on that in a moment. It has to be able to withstand a pandemic or thrive in a pandemic. It has to be able to withstand and thrive in a recession. It has to be a multi-billion-dollar tenant with an investment grade credit rating. What I mean by investment grade credit rating is that they have proven over the long haul that they pay their bills on time. So, a multi-billion-dollar tenant with an investment grade credit rating that will guarantee your lease payments. So, the guarantee is not from the store, but it's from the tenant. So, that's very important. Then, once you have that, you want to get the longest possible lease term, and that can be 10, 15 years. Some of these are 15 years with 4 or 5 year extensions. You Once you have that in place, you want to have the best possible return. But the best possible return isn't your first consideration. The quality of your tenant is the most important consideration, their ability to keep their word. Once you have that, then you really want to start looking at demographics because real estate fundamentals do matter. If I give you a store, if you have a store that is in a former cow pasture versus in a store that is downtown, the fundamentals are certainly better downtown. Now, there's certain interesting exceptions to that. If you look at a tenant like Dollar General, which is exploding, Dollar General has came up with a brilliant idea that in order to have uh, a successful store, you need to have customers, but those customers don't need to live by you. And matter of fact, 99.9% of the clients that you have are going to be driving to your store anyway. So why not have your store outside of town just a little bit, but where there's a significant number of vehicles per day? I think that is absolutely brilliant. And Dollar General, for instance, not only are 65% of their stores on the outskirts of town, they're on the going home side of the street. So, in the case of dollar stores, um, they can sell their ware for so much less money because they don't have the big burden of the real estate. So, uh, I prefer a mix. I like to have a population of over 10,000 within a 5 mile radius. I like to have a median income of over $40,000. In a lot of the country, that's sufficient. With uh, I like to have an area that is expanding or stable, not contracting. And I also like there to be a good number of businesses and a good number of employees. So if one sector goes out of business, the whole area isn't going to fail. So those are the requirements that I have, and I can't say that one is more important than the other. They're all they all play together. So for instance, if you get a triple net property with a 5 year lease versus a 15-year lease, you're going to get a better return. If you get a property that's got 500 people versus 50,000 people in a 5 mile area, you'll get a better return. But is the better return really worth it? Um, it's a matter of really looking at all of the variables. And one of the things that we do is when we send out a property list, that we provide all of the demographics for that so you can play with that. Because even though we can provide you that information, you have to get a sense of what you're comfortable with. Everybody wants a higher cap rate, but when you realize what you may have to give up, I say it's much like health insurance. Hopefully that's the best money you'll waste. Hopefully you'll never have to use it. A well-placed triple net property will not only go through its initial, let's say, 15-year guaranteed lease term, but with 5 years, with five-year options, that could last you for 40 years, at which stage you've won. And at that stage, that's, if a well-placed property, your real estate will be worth more, and, you'll have you'll still have a more valuable piece of property.
That's right. And then you also have to determine how much risk you're willing to take as well. I mean, risk plays a really big part in all this, because, and you touched on this earlier, is the length of the lease it's gonna reduce risk, but it's gonna have an impact on your general return, right? Because it also delivers more certainty. And when you have like I think, what was it? Was it a Walgreens? They give you an 80-year lease, but then it renews every 5 years. So technically, it's a 5-year lease. So that's like that. What does a cap rate look like on that versus, like, say, a Starbucks that has a 15-year lease, right? And you have to try to weigh the pros and cons along with population growth, income levels, traffic, all these different things that come along with it, right? So it's a little different play. It's a much different play.
Well, it is, and it even gets sillier than that. What I find to be very humorous is that, and I'm going to use some broad brushstrokes here, a Dollar General today will sell at about a 6.5 cap, about $1.5 million, right around there. And that's at a 6.5 cap. A Walgreens might be at a 5.5 cap. An AutoZone 5.5 cap. A Chick-fil-A 3.5 to 4.5. A Starbucks 4.5 to 5. Now, considering that the definition of a cap rate is income over value or price, logic would dictate that if you're making $100,000 on any of those tenants, that the cap rates should be the same, because actually what you're buying is the promise of future payments. It doesn't matter who your tenant is. But there is this thing in our industry called a vanity factor. More people would rather say that they own a Starbucks at a 4.5 cap than perhaps Dollar General at a 6.5 cap. It's nuts. But considering your only association with this tenant is that you get a check every month, it doesn't matter who it is or where it is, as long as your tenant is solid and there are no weasel clauses. And
right,
just an oddity in our industry.
Right. Well, I was just thinking about that too. It's like the Starbucks having a lower cap rate than, say, the Dollar General, but they have this weasel clause in it, where I don't think Dollar Generals typically don't have this weasel clause in it.
No, they don't.
Right. It's ridiculous. I mean, I would choose a Dollar General over a Starbucks any day of the week, honestly.
Yes. Well, that's why you're where you are.
It's crazy.
There's nothing romantic about triple nets other than certainty of income for the longest possible time, and a better certainly out in California, a better cap rate than multifamily.
Right.
And you never have to talk to a tenant, which is wonderful.
Yes, it is. I can attest to that. Now let's talk a little bit about different types of assets in terms of not just, we're talking, I know, retail here, single tenant. When it comes to gas stations and when it comes to, like, say, car washes, things like that, very different type of business. Those are typically triple net as well, a little
Sure.
bit stickier, but they come along with their downsides as well, especially as it relates to environmental stuff, right? But it sounds, just from my own research and what I'm doing with triple net anyway, you don't really have to take on that risk, so to speak, not directly anyway, when it comes to the environmental stuff, right?
Well, you have to read the lease. You should not have to, but the devil is in the details.
Mm.
That is one time when you really have to pay attention. Now, in talking about different asset classes, let me give you a few good examples. Yesterday, the quarterly report came out for Dollar General. Their sales have gone up 80.5%. That's
Wow.
0.5.
Is
That's
that's overall, or is that per store, or
overall.
overall? Wow.
That's not believable. Now, that's what they submitted to the SEC, so it is believable, but it's wow. Uh, Caliber Collision, perfectly fine store. During this pandemic, nobody's driving, nobody's crashing. So Caliber Collision asked their landlords to please accept 40% less in rent. Uh, restaurants, we all know what happened to restaurants. I mean, they're falling by the wayside. So your asset class is very important. Medical properties are promising. There are a lot of regional urgent care or healthcare centers. Those can be promising. Those are also in the $1.5 million range, which means you need $400,000 equity to get into it. Ultimately, we all have kind of a preference toward the type of tenant we want, but what you should really look for is, number one, how strong are they? And how well will they do given our unique set of circumstances? One of the interesting things about dollar stores is that half of the people who shop at a dollar store don't have credit cards. Very hard to have Amazon compete with you when people don't have credit cards. They also, only buy $15-20 worth of product at a time, and that's usually on the way home from work. It's a convenience store. So stores like that, tenants like that are very strong, whereas tenants that rely on something else can be problematic, like Caliber Collision, any of the collision stores, or even the auto stores right now. If nobody's driving, nobody is fixing up their cars. So, there's a set of tenants that we prefer. Dollar stores. I don't in the dollar store area. I prefer Dollar General. Uh, Dollar General has 15-year terms versus Dollar Tree Family Dollar 10-year terms. Dollar General is a triple net, which we call an absolute or a true triple net because it really is a triple net, versus Dollar Tree and Family Dollar, which they call a triple, which is a double net, which means that you are responsible for taxes, insurance, or maintenance. And as you might guess, it's the maintenance that you're responsible for, which would be structure and roof. So that's good. Paint stores, people are fixing up their house. But there's really a small set of tenants that we recommend in this environment.
Yeah. Yeah. And that's the thing though, too. It also sounds like you're diversifying your tenant base as well, right? So it's not just dollar stores you're going after. You're also adding other types of tenants as well to the portfolio as you continue growing, right? So
Yeah.
that's one way of so it sounds like you're selecting not only robust tenants that'll go the distance, but also within that group of tenants, you also have ones that are somewhat not prone to falling down when the economy has a sneeze, that kind of thing, right?
Correct. Absolutely.
Yeah. I mean, and what we're going through these days is probably one of the biggest sneezes we've seen in a very, very long time. And to your point, Dollar General is certainly doing quite well, doing very well. So it's good for them. That's awesome.
Yeah. And
Yeah.
Warren Buffett recently said anybody who says they can tell you what's going to happen tomorrow is an idiot.
Yeah.
He is sold out of, the only stocks he's purchased this year are Japanese conglomerates. He sold, of course, all of the airlines. He sold Goldman Sachs. He sold 100% out of Goldman Sachs. I got to tell you something. That's interesting because he knows what's happening.
Yeah.
So, the triple net play is not the right play if you want to make a killing in real estate. It's the right play if you want to make sure that you're stable for the next 3 to 5 years, that whatever happens, you're in good shape.
That's right.
That's really the play.
That's right. Excellent. Now, Kenneth, if you had one piece of bulletproof advice, what would you give to that person listening right now?
Well, the one piece of bulletproof advice that I would give someone is really to know what it is that you want to accomplish in real estate. And if it's just continually building and, trying to make more and more and more, triple net probably isn't for you. But if you want a secure foundation, if you want to know that whatever happens to the economy, whatever happens to the stock market, whatever happens to real estate, that you are going to have a stable source of income, then I would say a triple net property is the best bet out there.
Excellent. Yes, and I totally agree. That's why we're doing it. So good stuff. All right, guys. Well, if you want to reach out to Ken, you can reach him via the contact page of his website, triplenetcompanies.com. I hope you got some insight on how you can build that steady cash flow in the triple net space. Thanks for tuning in, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.